Hello and welcome to Small Golds. In case you missed it, top gold and silver stories from the week ended July 23rd, 2016. The top story of the week was a WikiLeaks dump of the Democratic National Committee documents that showed that the Democratic National Committee works hand in glove with the mainstream media to produce stories that are suitable to the Democratic National Committee narrative about Hillary Clinton and also about squashing the candidacy of Bernie Sanders. Now, while those stories in themselves were newsworthy, the main story of the week was the mainstream media's refusal or just trying to ignore the story when it came out. When the leaks were out, you would normally expect investigative journalists to be digging through those leaks to see what's in there and then report on them. Instead, the mainstream media all but ignored the leak, and when they finally, at least when CNBC finally reported on the WikiLeaks, they reported on it as such. The news took center stage on social media after they ignored it. Now, what the mainstream media could have done was they could have reported on the leaks. They could have even put their normal slant on it. They could have said leaks are bad, privacy is good, the Republicans do worse. But no, they chose because they knew that Friday, Hillary Clinton was going to announce her vice presidential running mate, her candidate for vice president, and that the Democratic National Convention was to get kicked off on Monday, and they had already had their stories written and they were ready to go with pumping up the new vice presidential candidate and then pumping up the Democratic National Convention. They did not want a story about how they are complicit with the Democratic National Convention in promoting a narrative. So instead of reporting on it, they reacted to it. Now, to me, this is a positive sign because one of the complaints I've had about alternative media is while they do a good job pointing out some of the inconsistencies, to use a euphemism, in the mainstream media's reporting, that mostly alternative media is reacting to a mainstream media narrative and not creating their own narrative. However, here is a case where the mainstream media had a pre-planned narrative. It was to promote Hillary Clinton, her vice presidential candidate, and to pump up the Democratic National Convention. However, they were forced eventually to respond to the narrative of the WikiLeaks and to respond to the narrative on alternative media and respond to the narrative on social media because their story was crafted as such as if that's where the news was, which is a positive sign in my mind because people want the news not that's given to them. They want the news that interests them. And of course, the reason people are interested in this story is many have considered perhaps that the Democratic primary was rigged, as Donald Trump had suggested. And here you had what looked to be supporting documents, not necessarily proof that that indeed was the case, but the mainstream media refused to report on it, and they were left on their heels responding to reports that they weren't responding to it and responding to reports of actually not necessarily what was in there, but that the social media was covering this story and the alternative media was covering the story and they were not. Let's move back now to economics. There's no obvious top economic story of the week except the main story for me is that the US equity indexes, the Dow Jones and the S&P have hit record highs despite the Brexit, the global uncertainty, the declining earnings growth. Somehow the US equity markets are now higher than they've ever been before other than NASDAQ. Give it time. In fact, even though gold has had a tremendous run this year, the equity markets have outpaced gold as of July 22nd so far this year. So for all the people talking about documenting the collapse and collapse is imminent, wouldn't be so sure because if central banks can print money and buy stocks, as we'll see later, they can push the stock market wherever they want to push it. They can put the prices of gold and silver almost wherever they want to push them because they have controls over the levers. So sitting around waiting for them to make a mistake and saying that the central banks are losing control, I'm not quite so sure. You may wish they are losing control, but when they control the money supply, they control the interest rates, they seemingly control what gets prosecuted and what doesn't get prosecuted. I'm not quite sure they're losing control. And for the stock market to be where it is, when there's no corresponding economic data that would indicate that stocks should be at all-time highs, that to me is evidence they're in control. Gold and silver, they were down last week. Gold closed at $13.22, down 1%. Silver closed down $19.59, or 3%. The gold-silver ratio inched up to 67.49 to 1 as a result of the decline in silver being greater than the decline in the price of gold. We saw that the gold-silver ratio had reached 83, 84 to 1 earlier in the year. It dipped down to about 64 to 1 earlier this month when silver outpaced gold and has now inched back up to about 67, 68. Chart of the week. Silver ETF demand is up to about 600 million ounces now that are being held, not demand, but silver that's being held in the various, or supposedly held in the various ETF vaults, is now at 600 million ounces. It's gone up a bit. Unlike the amount held has gone up a bit. Unlike the gold ETFs, which has experienced a decline in holdings, silver, as you see, really never did. It's always kind of been in the 550 range ever since 2012. 550, 600 has gone up a bit since then, but not like the decline that we saw in gold ETFs, and then they're ratcheting up. So with silver ETF warehouses holding about 600 million ounces of silver, and the COMEX warehouse is supposedly holding about 150 million, you've got almost a year's worth of global silver mining production locked up in those two types of vaults. Because if you do about 850, 880 million ounces a year in global silver mining production, China does about 100 million of that. None of that leaves China. So basically, between the ETFs and COMEX, there's locked up a year's worth of silver mining production. Here are the stories we followed or commented on. One of the things this week we'll see is there's a lot of, they're coming out of the woodwork now, anti-silver, anti-gold stories. The concept is that silver and gold, they had this little blip run. Now it's over. Why silver's post-Brexit bull run may soon be over. Gold, Chinese chorus caught smuggling. You see those stories all the time. We're not going to go through those. There's a lot of interesting stories in this blog post. I'm not going to cover them all. So if you scroll through them, you can pick out the links that interest you, click on them, and check out the stories. One story, the Silk Road Fund was reported to be purchasing a gold mine. And if you go over to the Daily Coin, Rory Hall covers this in an article entitled Gold, Guns, and the New Silk Road. And there's a video that's attached to it that covers all the alternative structures that the Chinese and others in Eurasia, are with Russia, are setting up kind of as a corollary to the Western economic structures. And he's reporting on this particular circumstance, the Silk Road Fund purchasing a gold mine. And that's pursuant to something we reported last spring, where there was a Chinese gold fund that had been established to buy, to help the Silk Road countries buy gold and gold mines. And that was funded with about $16 billion. So it looks like that fund is now active. As I mentioned, the new narrative this week is pumping up the U.S. economy. Yahoo has got a couple of stories early in the week. The economy suddenly looks great. Another one, secular bull market beginning. How the stock market today is reminiscent of two of history's most exciting buying opportunities. We have a bull market that's been pumped up for the last 6-7 years, and they're still now trying to introduce the narrative that the best is yet to come. Now, normally bull markets don't last that long, but I guess manipulated ones don't have lifespans other than the lifespan of the manipulator. Hedge funds finally say no to gold and U.S. shares as U.S. shares smoke records. Investors judging the world economic outlook as a bit more stable are taking some of the shine off gold. So investors, they would like to use the general term as if all investors are no longer interested in gold, and that's taking the shine off gold, as in U.S. shares smoke records. Again, that was in Yahoo Finance. So you had three of those stories all early in the week, setting a new narrative that this gold and silver spurt was temporary, but the stock story remains intact. It is the story. It's always the story. Stocks today, stocks tomorrow, stocks forever, I suppose. Bloomberg sometimes gets it right. They had a story, low interest rates, presidential uncertainty boosts gold. And that is the story. That is a long-term story. That is not just a small spurt. There are low interest rates. There are negative interest rates. There are zero interest rates. That doesn't look like anytime soon that will change. There is presidential uncertainty. There will be presidential uncertainty no matter who gets elected. If Trump gets elected while he's in office, no one knows what he's going to do. He will probably have a surprise a week, a surprise a day that will impact the markets. Hillary Clinton, same thing. If she gets in, there'll be a lot of, supposedly, there should be Republican opposition to her. There may be protest against her. Who knows? There is uncertainty no matter who becomes president, and there's certainly uncertainty up until November because we don't know who will be elected. Interesting story from this Willem Buter guy who was the head of Citibank, Citigroup, whatever he was. He has been a perennial gold, not a gold bear. It's someone who's anti-gold. Gold bears are people who think that gold at the current time or at some point in time is priced too high and is not a good thing to be buying, so they're bearish on the direction of gold. This guy, Butler, he's against gold on moral and ethical grounds and economic grounds. He wrote an article 7 years ago, not gold, that gold was a 5,000-year-old bubble. And his point was that fiat currency is superior and that gold is basically a barbaric relic, and there's really no reason for central banks to hold gold. There's really no reason for anyone to hold gold. In any event, he recycled that piece of research that he did on gold being a 5,000-year-old bubble on the eve of the Save Our Swiss Gold referendum, which was held in Switzerland over a year ago, which failed, which would have required the Swiss National Bank to buy gold, to stop selling gold, to repatriate its existing gold. And that referendum was defeated in part by massive propaganda coming from central banks, including the Swiss National Bank, obviously, and the mainstream media, because they were saying this was going to hinder the Swiss National Bank's ability to conduct effective monetary policies. We'll see later, they're buying shares, equity shares. But in any event, the guy who wrote this article, and it was one of the propaganda pieces that helped the Save Our Swiss Gold referendum fail, he came out and said he would hold gold now based on the uncertainty that exists right now. So you have a guy who's anti-gold saying he wants to hold gold. That is an interesting development. After Brexit, ordinary Britons move into gold. Now here's one that's also very interesting, where you have the Wall Street Journal basically trying to push the narrative that the gold run is over, could hit roadblocks because there's a lack of inflation, there's Fed action, calmer markets, speculative investors all pose a problem for gold. And that's basically the narrative they're trying to suggest. Interesting though, look at the URL of that article. Go to the bottom left. I can't point to it without losing the URL. Go to the bottom left of your screen and you can see Wall Street Journal articles. Gold could be headed for substantial bull run. So now you've got, they're trying to play both sides of the fence. They realize that gold could go higher. They're trying to promote the propaganda that it won't go higher, but they've got themselves covered. They're basically saying that, look, the situation for gold is no good, but the URL says it could be headed for a sustained bull run. Bloomberg. Now here's where Bloomberg gets it kind of on the propaganda side. Investors pull most money out of SPDR gold in 8 months. And they're, quote, an improving economic outlook in the U.S. is sapping demand for exchange-traded funds backed by gold. Now, exchange-traded funds backed by gold in the last 6 months, in the last month, have hit record levels. I don't know how much gold has gone in, but the amount that they say has gone in on paper is higher than any other time in the history of these ETFs over the last 10 years. So to say that the demand for ETFs is being sapped, it doesn't fit reality. There's less gold going in, but there's still a massive demand for these products, whether that's the right thing for people to be investing in or not. But for Bloomberg to say that there's this improving economic outlook, it just fits in with the propaganda narrative. Then you have not just the stories trying to say that the economy is doing well and that the gold is kind of over and the silver push and it's all a spurt and that's over too. The stock market's going places. Labor market is robust, strong, strengthening. Real estate's doing well. Happy days are here again. You also then have the articles trying to convince people not to buy gold. So the LA Times, they called it public service announcer from the LA Times, had an article, beware of scary Brexit headlines pushing you to buy gold. Now, Brexit headlines, it's not like the gold dealer that they criticized in the LA Times article invented the scary Brexit headlines. The scary Brexit headlines were invented by the central planners and the mainstream media because they're the ones who created that narrative that if Brexit went through, it would be an economic calamity that we hadn't seen. Someone said it would be the worst thing since Hiroshima or something ridiculous, without the millions of people murdered. It's just unbelievable that they would say that the scary Brexit headlines are something you should avoid when a gold dealer tries to sell you gold. Because if we were to believe what they said, of course those headlines were scary. And in fact, they turned out to be at least temporarily correct, because after Brexit, the Prime Minister of England resigned and the stock markets did crash. So what the gold dealer was doing was not playing off of those, inventing those fears. He was actually reporting on what actually happened. But the LA Times basically said that no, what you can't say there were governments were toppled and there was going to be a collapse. Well, that is what they predicted was going to happen. So the gold dealer is doing nothing different. And in fact, if you did buy gold prior to Brexit, you did fine. You didn't lose money in the stock market, and you did see that political turmoil in England. Economic Times of India, the media in India is also very, very anti-gold, works with the government to put out stories, invest in gold bonds, but not too much. Experts. So if you have to invest in gold, which they don't think you should at all, you should at least look at these bonds that the Indian government is putting out, where they'll give you interest for your gold if you just turn it over to them and let them hold it for you. Kitco had another public service announcement. Heavyweight champ George Foreman, a known investing specialist, said bonds are a knockout. Now, where he comes up with that, most bonds pay negative yields. They pay very little. But of course, it fits the narrative of don't buy gold. You can either buy stocks or bonds because bonds are a knockout. Sad story. Indian businessman famed for $240,000 gold shirt beaten to death. This, you might have seen this picture. There's a guy, he's got a gold shirt. It's worth $250,000. I don't know if he was killed for the shirt. You can click on the link, but he was killed in some kind of mob fashion. But anyway, you can read the story if you go to that link. Silver. Now here's one. Silver imports by India are set to plunge as jewelers grappling with slowing demand. Last year, silver imports into India were off the charts. They were 8,500 tons, 275 million ounces. They were, by all measures, at least 33% of the global annual silver mining production went into India. So they're down now. They're still at a very robust rate. They're at a rate of about 5,000 tons, or 150 million ounces this year, which is more than Mexico manages to produce in a year. So they're using this sense that they're set to plunge, but they're not really plunging. They're just coming off an unsustainable all-time high. U.S. Mint ends American Silver Eagle allocation. A story broke by silver doctors. They got the letter from the U.S. Mint to the authorized purchasers, and it shows that they're allowing authorized purchasers to buy as many American Silver Eagles as they wish. Now, they had been only allowed to buy 1 million Silver Eagles in the aggregate a week from January, February, March, April, May, June into early July. And they did indeed buy all of those Silver Eagles that they were allowed to buy by the rationing. And the U.S. Mint sold over 4 million ounces each and every month from January, February, March, April, and May. In June, the authorized purchasers did not take them up on their 1 million a week offer or allocation or ration, and they only sold about 2.8 million in June. This month, even though the allocation has been removed totally, they are no longer rationing the sales. The authorized purchasers have only bought about 1.2 million American Silver Eagles month to date in July, which means that they had stocked up earlier in the year when the prices supposedly were cheaper, and what they understand that maybe they would get more expensive later in the year, and there'd be a surge like there was last year towards the end of the year, where they would be amply supplied and stocked, and they could then sell those into the market at higher premiums. And you can see that's exactly what they did last year. Premiums rose to 50%. So if you're an authorized dealer and you sell to an authorized and you have a lot of inventory, you can mark up your inventory, sell them to the retail dealers. You can then also mark them up, and that's what happened. Retail premiums got to 50% last September, October, when there was a shortage of available American Silver Eagles. Since then, as you can see now, they're way, way down. So it looks like the authorized purchasers and the dealers are, for now, fully stocked, and you can get American Silver Eagles for $2-3 over spot price, which last year at this time you were paying a lot more over the spot price of silver. While we're on that topic, if you're interested in American Silver Eagles, you can compare pricing and shipping at these dealers that which Small Gold has an affiliate arrangement with: buygoldandsilvercoins.com, Golden Eagle Coins, JM Bullion, Money Metals Exchange. If you click on any of those links, you can compare their pricing and shipping of American Silver Eagles. And if you do purchase, you will you'll be doing Small Gold a favor, as Small Gold will receive a small commission, and you will pay no more, no less than you would have paid for your American Silver Eagles if you had gone to those websites directly. So if you'd like to help out Small Gold and you have already decided that and it's suitable for you to buy American Silver Eagle coins, then please check it out at Small Gold at this link. Also, if you're interested in any of any bullion, you can go to How to Buy Silver. You can click on any of the coins that are available through our affiliates, and also you can learn about the coins, their mintages, and a lot of data on the individual coins, and then you can compare prices at the 4 or 5 dealers that we feature. You do the same for gold. Also on the website, there's plenty of other offers. You can please check those out on the different coins that are available. You can compare prices, shipping, and inventory. And again, if you do manage to purchase your gold or silver from Small Gold, I would appreciate that, because I would receive a small commission and I don't charge anything for the site. So that's basically how the site funds itself, and doesn't actually fund itself, but it does cover some of the hosting and other costs associated with the production of smallgold.com. Okay, let's get back to where we were, which was Indian silver imports. And as we were discussing earlier, so far to date, there has been 1,600 tons approximately of silver imported into India, which at this pace would bring it to about 5,000 tons, which is a very robust amount. And remember, India imports most of its silver towards the end of the year. So at this current pace, they should end up around 5,000, 6,000 tons of silver this year. And so far this year, even though Bloomberg is reporting it as some type of plummeting demand, Indian silver imports through the first 4 months of 2016 are over 50 million ounces, which is more than the U.S. Mint produced last year in its record production of 47 million American Silver Eagles. So if you go to April 2016 Indian silver imports, there's a lot more charts, information on the Indian silver market. If you click there, you can see that. Going down now to gold bugs are gold bugs Donald Trump supporters. That's an interesting story in Town Hall. Basically says that gold bugs perhaps are Donald Trump supporters, not because Donald Trump is a gold bug himself, but because Donald Trump adds some uncertainty to the global markets, which of course is always good for gold. AntiGold Stories. Rory Hall at the Daily Coin did a fine job on the Los Angeles Times story that we mentioned earlier in the podcast. He went line by line through the Los Angeles Times story, trying to convince people not to fall prey to a gold dealer's advertisement to buy gold. And Rory lays it all out in a piece called Gold. Be afraid, be very afraid. And he goes through the reasons, as we mentioned above, why the gold dealers promotion of his product was in fact above board and nothing to be wary of, and in fact indeed makes perfect sense. So please check that piece out over at the Daily Coin, or you can just click on this link here. It'll take you straight there. Silver posts longest slump in 8 months as Citigroup flags risks. Now, this one sounds like it's an anti-silver piece, but it really isn't, because silver has risen about 50-60% this year, 20% in a month, even though silver is at a historic low when it was at $14 on a relative basis to other commodities and assets. It's still, anytime something rises that quickly, that fast on a percentage basis, it is due to some kind of a pullback. Interesting deployment of silver mining company's assets. There's a small mining company in Mexico, Araucana. I think most of its mines were put out of commission just to save money during the last few years because the price of silver had dropped. Some silver mining companies stayed in business. They produced their silver at a loss just to stay in business. Other companies just shut down rather than incur the loss. This is one particular case where the silver mining company actually had areas under its control that were good for producing oil, so they got an upfront payment to from an oil company, and they're going to receive some revenues from that. So a silver mining company making money from oil production. Indian gold imports, they are down, and they're down mainly because of the import duties that the Indian government has on them, but also because of the gold tax that they have on jewelry, which has been relaxed somewhat on the smaller jewelers, but the larger ones still have to pay a 5% tax. So coupled with a higher gold price, this high import price, the gold imports have fallen. Now, I'm sure there's a fair amount of smuggling. We see stories all the time, people getting caught. Those are just the stories, people getting caught. Who knows how much gets through to India, but there probably is somewhat of a decline in demand for gold in India, only because the price has risen and Indians are price sensitive. They do buy when the price goes down, and they are probably waiting. India has had these tariffs before. They've removed them before, so chances are they'll remove them again, and there's a possibility gold price will go down again. So Indians are price sensitive. It is their savings. They buy opportunistically, and it's probably not an opportunistic time to buy when, especially if you want to buy gold jewelry, you got to pay a 5% sales tax, you got to pay the duty, and you got prices where they are. So those factors are harming gold demand at the moment. Russia's gold reserves grew by 600,000 ounces in June, or about 19 additional tons. They're now at 1,500 tons at the Russian central bank as reserves, which represents about 13-15% of their overall reserves. If you click on this link, this is only one chart I'm showing you here. There are many charts on Russia's gold buying habits, how much they buy each month. There's a chart on that. There's a chart comparing Russian gold acquisition to compare to Chinese gold acquisition. There's another chart about, which you'll want to check out, Russian gold mining production, how much of that they keep in the country, how much of that they export. So if you click on any of the links here, including the small gold links, there's a lot more information than you're getting just on this podcast. Post-Brexit, IMF clowns, this is in my language, this was from the Express in the UK. IMF clowns forced to admit Brexit economy is growing despite predicting Brexit doom. Yep, the IMF came out and said that the UK economy is projected to grow at a faster rate than either Germany or France. Even though they're the ones who said, please don't vote for Brexit because economic calamity, especially in the UK, will occur. Now they're being forced to admit that that's not the case. Swiss National Bank stock holdings. The Swiss National Bank, I'm not making this up, owns 2,592 positions in equity securities, including Amazon, Apple, IBM. I'm not going to list all 2,592. But this highlights that central banks not only buy bonds, the European Central Bank's buying all types of sovereign bonds across the Eurozone. The Federal Reserve bought 2.2 trillion in U.S. Treasury securities with money they printed out of thin air. They bought 2 trillion worth of mortgage-backed securities that weren't worth much anymore. And now you've got reports of the Swiss National Bank. This is on record. This isn't maybe central banks are buying, which many suspect they are. This is a Swiss National Bank reporting that they own positions, 2,600 approximately positions in U.S. equities. That highlights that stocks move because of intervention, not because of earnings growth, not because of robust economies, solid jobs reports, general economic. No, they move up because interest rates are fixed. They're fixed lower. Central banks put liquidity into markets, and the Swiss National Bank reports that they buy equity shares. They buy companies whether they make money, whether they lose money. So basically, these are government subsidized stock gains. U.S. Mint sales update. We won't go through this. They've been low. The gold sales are pretty low this month. They'll probably do, I don't know, 30,000 ounces of American Gold Eagles. They'll probably sell 1.5 million, less than 2 million American Silver Eagles. So while the stock price has risen, it's not because of retail sales, at least not in the United States. It's due to that supposed ETF buying and because trader sentiment on the COMEX is high and there's a lot of paper trading of contracts betting on the price of silver and gold going higher. The GOP has in its platform a proposal to study the return to the gold standard. They had one in 2012. This probably won't go anywhere. The last time since 1971, when Richard Nixon unilaterally took the United States off the gold standard required by the Bretton Woods agreements in 1971, the Bretton Woods agreements in 1944, Nixon took the U.S., refused to pay those central banks that wished to redeem dollars for gold as they were allowed to do under the Bretton Woods agreements in 1971. When he did that, that effectively ended the gold standard in the United States. From then on, the gold would be backed, the dollar would be backed solely by, quote, the full faith and credit of the United States. And the way they created demand for dollars was they convinced Saudi Arabia that they would price their oil in dollars and only accept dollars for their product. And that, of course, made countries, irrespective of the intrinsic value of the dollar, it made it a requirement that if they wanted to buy oil, and all the countries needed to buy oil, they would have to hold dollar reserves because they'd have to go to Saudi Arabia and pay them in dollars, and they were quoted in dollars. So that's created kind of the U.S., it's kept the U.S. dollar as the world reserve currency. But in any event, in 1982, when Nixon took the U.S. off the gold standard in 1971, that set off a decade of inflation, stagflation, and poor economic growth in the United States, to the point where the United States was in serious difficulty. The dollar had plummeted. Inflation was very high. And when Reagan got into office, there was still a major problem, even though it was actually worse because Paul Volcker, the head of the Federal Reserve at the time, had raised interest rates to close to 20%. So now you had ridiculously high interest rates and you still had a poor economic economy. So they were looking at an inflation. The inflation hadn't broken yet. So they had appointed a gold commission to study returning to the gold standard. This one was pretty serious, and former Congressman Ron Paul and businessman Lou Lehrman, also gubernatorial candidate for New York in 1982, Lou Lehrman, they produced a report which recommended that the U.S. go back on a gold standard. That didn't happen, but it was considered. But the offshoot of the 1982 Gold Commission report, authored by Ron Paul and Lou Lehrman, had in it a provision where it was a recommendation that the U.S. Treasury begin to produce, for the first time since 1934, gold coins, and for the first time since 1964, silver coins. And they were in the form of the American Gold Eagle and the American Silver Eagle, which began production in 1986 and continued to this day. Had it not been for that Gold Commission and Ron Paul, we would not have those coins today, most likely, because if they weren't in existence today, I doubt anyone could be able to bring to the floor to Congress and convince the Treasury to produce gold and silver coin bullion coins, not collector coins, but bullion coins for people to buy. So thank Ron Paul for the American Gold and American Silver Eagle. Yet another story, a public service announcement from USA Today arguing that gold was not a safe haven. Another Indian story in the Economic Times of India telling people to ditch their physical gold and get your sovereign gold bonds. They actually said that these bonds would not be offered again next year. This tranche will go away. Well, they'll come up with another tranche, but so far, all the propaganda and all of the exhortations to ditch your gold and buy these Indian rupee bonds where you turn your gold in, you get paid an interest, have failed. As I mentioned, I think they've got about 3 tons of gold out of the 18,000 tons that are supposedly held by Indian households. And most of that gold that they got is from a few temples that decided that they could lease their gold to the government and at least make a little money back. The Perth Mint silver kangaroo sales at 10 million. The Perth Mint actually put out a press release on that. The Perth Mint has basically sold 3 or 4 times the amount of silver they used to sell, mainly on the back of producing that silver kangaroo silver bullion coin. U.S. economic data has been down, but initial claims were 253,000 versus an expectation of 265. This is a number that the propagandists love to promote, that initial claims have been down. They've been under 300,000. It's a sign of a solid, robust, strengthening labor market, lowest since 1963, which, by the way, 1973. 1973 was not a good year for the labor market. As I mentioned earlier, it was the very beginning of a disastrous decade for U.S. economic growth, high unemployment. So the fact that there were few claims now as there were back then is merely a function is there's fewer people working now as there were back then. The labor participation rate was low then, it's low now. When you have fewer people in the labor market, there's fewer people to fire. Very simple explanation for that, but yet Reuters likes to say labor market strength characterized by very low layoffs and a solid pace of hiring is boosting consumer spending, which in turn is providing a lift to economic growth. Now that's standard propaganda you get from Reuters on the economy. Just about every piece of economic news they report on has language very similar to that. Existing home sales, they're up over the expectations. However, existing home sales, the three-legged propaganda stool goes as follows. The stock market's at all-time highs. The labor market is robust and unemployment is low. And then the third is the housing market has rebounded and recovered. Well, yes, home prices are more expensive now than they've ever been before for new and existing home prices, except people have less money to buy those existing home prices. They pay those existing prices because wage growth has nowhere near kept pace with the increase in prices. However, even if you call a recovery making home prices more expensive, which makes home prices more unaffordable, the number of home sales, the number of homes that have been sold are not as good as they tout them to be. New home sales, even though they're up since 2010, are still at levels we last seen in the 1960s and the 1970s, which means the population has increased 40-50% and home sales are at those levels of the 60s and 70s. The existing home sales are up, but they're still at levels before 2004, 2005, at the height of the home sale craze. So while home sales are up, they're not really up on a relative basis. They're up compared to the relative historic basis. They're up to relative recent historic basis, but the prices are sky high. So I wouldn't call that a recovery. Again, I wouldn't call what's happening in the labor market strength. And obviously what's happening in the stock market is 100% fake because the valuations don't match the earnings. They don't match the underlying economy. I want to leave you with this. This is probably the most important point on the stock market. Analysts expect S&P 500 earnings to sink for the third quarter. If the index does report a year-over-year decline in earnings for the second quarter, it will mark the first time the index has reported 5 consecutive quarters of year-over-year declines in earnings since Q3 2008 to Q3 2009. That period of time was the worst period during the Great Recession, during the financial crisis and its aftermath. Of course, there was negative earnings coming out of the companies during that time period. It's also pre-QE. During that time period, stocks had plummeted. So now we have exactly the same circumstance, declining earnings, and yet stocks are at all-time highs. There is no way to square that with reality. That is 100% because of intervention. It's because they've lowered rates to zero, they've got negative interest rates, which has made buying or putting money to save as a losing opportunity. So what you do instead, they put the money into stocks. But it gets worse than that. Not only are people chasing that are individual investors and are institutional investors that are still in the stock market buying overvalued stocks, to the extent that they don't or won't buy them or sell them, we see central bank intervention like the Swiss National Bank. They're providing a floor to those stocks. They're buying those stocks. So you have negative earnings growth and you have a soaring stock market. You cannot make that up. That is, you can make, they did make it up. They have orchestrated a situation where the economy is slowing, you have negative earnings growth, and as earnings decline, the stock market soars. That does not happen, should not happen, and that is a red flag as to why the economy is 100% fake. Finally, Rory and I at the Daily Coin had a podcast. We do once a month. We cover the gold demand out of the Central Bank of Russia, People's Bank of China, and we cover Indian gold and silver imports. And we also covered this month, we had a tangent at the very beginning, a lively discussion on the underfunded pension circumstances in the United States. There's a lot more in this blog post. Please check it out. It's called, in case you missed it, Top Gold and Silver Stories from the week ended July 23rd, 2016. Don't forget to please subscribe to smallgold.com. You'll get access to respond to me directly via email. And also please subscribe to the YouTube channel that you may be watching this particular podcast on. Thank you very much.